Tyler, the calendar is switched over to November. Let's talk about some of our top stock ideas right now.
Always a good time to start talking about things. And I actually have not the most obscure stock you've ever heard of this month. So a little bit different flavor this time.
Yeah, you're actually going to be talking about the biggest company, standalone company in its particular industry. So that's going to be good. And it's interesting to see how that business continues to evolve over time and dominates. I'm Jason Hall. This is Investing Unscripted. I have a stock too, and it's one that had kind of a good run. Stock sold off a little bit more recently. It's created an opportunity for investors. We're going to get to that in a minute, though. This is Investing Unscripted. This video is sponsored by The Motley Fool. If you're looking for even more great stock ideas, you should check out our special link. It's fool.com/unscripted. Go check out that link and you can get access to the 10 top stocks to buy right now. Okay, Tyler, how about you kick us off here?
Yeah. So I'm looking at Cheniere Energy, which is, if people haven't heard of it before, it is the largest producer of liquefied natural gas and the largest exporter of liquefied natural gas in the United States. They have two facilities, one in Louisiana, one in Texas. This was a business that got off to a really rocky start. It started off as an import business, and then shale happened. They're like, oh man, we got to shift businesses really fast, and then went to an export business. Took on a lot of debt, did some really weird things. But
It's like the corporate equivalent of that scene from Spaceballs where the big robot had to go from suck to blow, right? You got to reverse the whole thing, and they managed to pull it off.
yeah, they did, and it was quite spectacular. I mean, there was a couple points where it looked like it was gonna go bankrupt or had to use some very, very creative financial accounting. Yeah, I think they should, like,
The
write.
corporate equivalent of pulling off the credit card to make your payment on your other credit card.
Yeah, I think that's underselling it a little bit, but that's a long time ago. This is now a very viable operation that throws off boatloads of cash, and as a result, has been basically taking that kinda shaky history and turning it into something that's really good. Last year, it got an investment grade credit rating, which I think if we had talked about this 7 or 8 years ago, we would have thought that's insane, but it's there. And management has basically taken this a very, very stable business. It's a business where it doesn't take any commodity price risk because basically all of its customers, all they have to do is pay a liquefaction and a transport fee to Cheniere, and they have to buy the gas and then pay the commodity price themselves. It's very like commodity price insensitive, and also it has very long term take or pay contracts, which basically means like, look, we're producing this gas, take it or not, you're paying us for it. And so it puts a lot of stability into this business overall. So what makes that appealing is if you can lock in these contracts and do it for a long time, if you can grow the business, it's like it's pretty assured. And that's what we're seeing right now. They just started to produce its first LNG from a new expansion of its Corpus Christi facility just a couple of months ago. And it also has plans for final investments decisions on further expansions in 2025, 2026, which I think combined with all of these expansions should increase capacity somewhere between 40 and 50% across its entire portfolio. So we're looking at pretty sizable increases in revenue and earnings with pretty good visibility over the next 5 to 10 years. In addition to that, like I said, it's throwing off a lot of cash, so it can pay for that itself while at the same time paying down debt. It's repaid about 4 billion so far and has a relatively modest debt to EBITDA ratio. It's actually bought back about 10% of shares outstanding over the past 2 years with an authorization to buy 20 million more shares already, and has a plan for the rest of the 2020s to increase its dividend by 10% annually. So there's a lot of visibility. You can basically see the trajectory of what this company wants to do all the way out to 2030. Obviously, there could be some operational hiccups along the way. Management has really articulated this is exactly what we think is going to happen over the next 5 to 6 years. And it looks like a good story, especially for a company that right now is trading for 12 times earnings and has a 1% dividend isn't great. But if you're growing it at 10% annually, in addition to some of the other things that it's doing, I think that's a pretty good value proposition.
Yeah, I think that's right. If there's one thing we learned about the energy industry, Tyler, is that the companies that operate the infrastructure, that basically act as toll booths and just take fees to move the commodities around, those are the ones that generally can be predictable, cash flowing, strong capital returning businesses for investors and help investors make money. And Cheniere might not have the big dividend that we see typically in that space, but again, because they're in growth mode, that's where they are. But the model fits very well with what the industry is familiar with and the demand for natural gas around the world in places that are really far from the supply means that LNG is set to grow. So I like this. I like that pick a lot. I'm going to go in a very different direction. It's not even close to in the same ball game, but we're going to talk a little bit about EPR Properties. So EPR Properties is a real estate investment trust that owns experiential properties, and the stock has had a very, very volatile past few years. So this is the pandemic. The stock absolutely plummeted with every other stock, and you see still hasn't fully recovered back to those pandemic highs. Their dividend yield initially collapsed because they had to slash the dividend. And then what we see is the dividend yield has really skyrocketed. And I'm just going to look at the past 3 years. You see it's really skyrocketed because the stock price has stayed pretty low because there's this expectation that the company's exposure to the movie theater industry is going to hurt it. Its cash flows are going to suffer, and the dividend is eventually going to get cut. Here we are, multiple years in the story. It's not really played out. I'm going to talk about a couple of things from the results. The earnings were down, and FFO, funds from operations, that's really your proxy for earnings per share for REITs because they get to back out some expenses that they still take. You depreciate real estate. Real estate generally goes up in value over the long term, so you remove that depreciation from it and you get FFO. So their funds from operation fell a little bit in the quarter. So the market doesn't love it when that happens, but they did raise their guidance. They tightened the range of guidance for the full year. And at the midpoint of guidance, it's about a 3% increase from where the range was before. So they're saying, look, our business is still strong. It's still steady. We're moving forward. If you look at their entire portfolio, theaters still makes a pretty big chunk of their rents cash flows, about 36%. That was over 40%, Tyler, a year and a half ago. They continue to reduce their exposure, sell off properties in that industry and move away from it. At the same time, they're moving into things where there is strong interest from consumers. As a result, you put it all together and you have a business that I think is still relatively misunderstood. It's priced for more risk than I think is there. And I think investors still have some margin of safety as well built in if the movie theater business does continue to struggle. But we've seen it actually stabilize a lot, and they've been able to de-risk the portfolio by selling off more of those properties. More recently, the stock price has come down a little bit. Let's push the dividend yield back up. I think is a good timely investment, a good opportunity to add to an existing position if you have one, maybe start a position if you don't. This is one of my favorite, little bit risk reward, but I think mispriced REITs with a good high yield. And I think November is a great time to be buying shares of EPR Properties.